Hello everyone and welcome to today's Global Market Highlights. I'm Molly Dai. Thank you for being with me today. I will start with a snapshot of how markets have performed this month and then touch on what the latest macro data is telling us about growth, inflation, and policy. I will also walk through our current asset allocation views before closing with a practical reminder on long-term investing, particularly relevant when markets are near record levels. This will share today are for information and training purpose. They are not investment advice, and market views may evolve as conditions change. Let's begin with market performance so far this month. Starting with equities, global markets have continued to move higher overall, with leadership becoming less concentrated than last year's heavy focus on AI-related sector, while U.S. equities have been more mixed in the near term. Other regions, particularly parts of Asia and European markets, have shown stronger momentum. The key reason behind this shift is selectivity. Earnings remain broadly supportive, especially in technology, but elevated valuations in a small group of mega-cap stocks have pushed investors to look elsewhere. Capital is rotating towards markets and sectors where expectations are more modest and valuations are more attractive. This broader participation is a healthier sign. It reduces the dependence on a handful of names and supports a more balanced and resilient equity markets. Turning to fixed income, February have been characterized by volatility rather than a clear trend. Government bond yields moved lower at points during the month as inflation data shows signs of cooling, but this was offset by concerns around heavy bond issuance and fiscal pressure. As a result, bonds returns has been driven more by carry than by capital gains. Credit markets have remained relatively stable, with spreads still tight, reflecting resilient fundamentals, but also leaving little room for disappointment. Overall, markets are navigating a familiar tension, supportive earnings and policy expectations on one side, and valuation, supply, and geopolitical risks on the other. Looking now at the macro picture, the data points to slowing but still positive growth. In the U.S. economy, momentum moderates towards the end of the last year. Parts of this reflect softer consumer spending and also some reasons from the government's shutdown temporarily from earlier policy uncertainty. So that said, activity levels remain consistent with a soft landing narrative rather than a sharp downturn. On inflation, progression continues, but it has been uneven. While headline pressures have easing, underlying inflation, particularly in services, remains persistent. This stickiness is a key reason policymakers are reluctant to declare victory too early. The labor market has been another area of focus. Recent employment data surprised on the upside, reinforcing the message that economy has not weakened enough to warrant rapid policy easing. However, job gains has been concentrated in a narrow set of sectors, while rising questions about how broad and durable this strength will be as a growing slow. Against this backdrop, the Federal Reserve has chosen policy rates to remain on hold, with growth cooling but employment still resilient and inflation not yet fully normalized. Policymakers are signaling patience, preferring to wait for clearer evidence before adjusting rate. Looking ahead, upcoming inflation prints and much policy meeting will be key in shaping expectations around the timing and the pace of any future easing. So how are we positioning portfolio in this environment? We remain modest overweight in global equities versus fixed income. A combination of steady growth, gradual easing inflation, supportive liquidity, and solid earning continue to underpin risk assets. Importantly, leadership is expanding beyond U.S. technology. We expect more market volatility with continued rotation into ex-US regions and non-tech sectors. Within equities, Asia ex-Japan remains an area of relative preference. Stronger earnings momentum in Korea and Taiwan from memory and semiconductor cycle, cheaper valuation compared with developed markets, and stronger technicals. Regional flows remain supportive. Growth drivers in the region are also becoming more diversified, extending beyond a single theme. In fixed income, we remain more cautious. Longer-dated bonds face limited upside as investors demand higher compensation for fiscal risk and policy uncertainty. While investment-grade credit continue to offer income, heavy insurance and tight spreads means selectivity is critical. We also remain underweight high yields, where valuation provide limited protection if conditions deterioration. Finally, with sentiment improving, we see scope to gradually redeploy cash into risk assets rather than staying overly defensive. I like to close with a question that often comes up when markets are near all-time high. Should investors stop investing at market peaks? History suggests that new highs are not necessarily a reason to stay on the sidelines. When we look across multiple decades, investing at or near previous peak has, on average, still led to positive outcomes. And those outcomes improve meaningfully over a long holding period. This highlights one of the most common investor mistakes: trying to time the markets. Stepping out during the periods of uncertainty may feel prudent, but missing even a handful of strong recovery days can significantly undermine long-term results. For investors who feel hesitant about committing capital all at once, a disciplined approach, such as investing gradually during volatile periods, can help manage emotions while keeping money invested. The key message is simple. It's time in the markets, not timing the market, that has historically driven long-term outcomes. That brings us to the end of today's session. Thank you for your time and for your participation. In the environments where markets continue to evolve, staying diversified, disciplined, and focused on long-term objectives remain essential. We look forward to speaking with you again at the next session. Thank you and have a great day.